Hey, Bulls and Bears, what is happening? You're watching Bull Boom Bear Bust. It is August 3rd. That makes today Thursday, 2023. Back with another dose of economic reality. They continue to kick the economic can down the proverbial road. We've got more ways to keep people from basically becoming homeless, more programs basically to help people, but yet the economy's so strong, there's no problems, everything's fine. But here's what we have to do: the students that are going to be attempting to repay their loans, they can ignore their student loans. This is out of Bloomberg, because leniency is guaranteed. So there's going to be no late fees. There's going to be no fees at all, in addition to the accrued interest on the actual loan. Now, that's going to be a lot of money now, especially with rising rates. Hopefully, these rates are locked in. I've never had a student loan, so I couldn't tell you myself. But we do know, and I did predict right here on this channel, that they were going to find new creative ways to quote unquote help people. Helping people would just delete the debt, like similar to bankruptcy. But you can't do that for the most part with the student loan. They don't let you do that. So they are still finding ways to kick the can down the road. These students, 43 million people in the United States with student loan debt, are not going to be able to resume their normal monthly payments. We said that right here. There's just too much debt. The cost of living is too high. Something has to give. And it's not just speculation anymore. It's obvious. If they have to do something like this where you don't get late fees or penalties, um, and it makes perfect sense because people are too broke, too many people living paycheck to paycheck to go back and to resume normal monthly student loan payments. It's just not going to happen. So I expect more leniency to get granted, to these borrowers. I expect programs to come out that are going to help people when the foreclosures start increasing. I expect programs for all types of debt. They'll probably put a freeze on credit card payments for hundreds of millions of people that have credit cards, and not long from now, millions of people will not be able to make their minimum credit card payment. This is just how this has to end. It doesn't mean that there's going to be a collapse. It just means that they're going to find new ways to quote unquote help people to keep basically Armageddon from happening, on the streets here of the United States of America. Let's go on to a different topic here. We told you yesterday about, yeah, it was yesterday, about the debt downgrade. The U.S. is now rated double A plus instead of triple A. They put the plus in there to make it not so bad, I guess. And that initially caused some panic in the market. But I've said here that any investor should know that the United States should not be rated AAA to begin with. We're the world's largest debtor nation. We print the most money, and the only reason economic growth looks strong in this country is because we can print all these dollars to buy goods, and people can pay for services, with this money that's created out of thin air. So of course we're going to look like a strong economy. But the truth is, we're the world's largest debtor nation, and we're never going to be able to repay this debt. Look at global debt; we're over $330 trillion. All these countries borrowing money, and I just think the entire globe is about 330 trillion, and we're over 30 trillion just here in the U.S. So we're a big chunk we're about 10% of the global debt here in the United States. When you look at the global debt versus the national debt, 10%, but we only make up about 5% of the world's total population, right? So go throw that into your calculator. So it's a lot of debt we have. And, I told you that this was not going to be the panic that caused the market to sell off. And sure enough, today on Thursday, August 3rd, we had the Dow Jones, and the NASDAQ, Russell 2000, S&P, down just a fraction of a percent, right? So no huge sell-off like some people predicted, with the U.S. now being a lower credit rating according to Fitch. Now, Fitch may go back and revise this like I think they did back in 2011. I have to look back at the date, but I believe it was 2011 they came out, they tried to downgrade it. They received some pressure, or maybe they received a payoff by somebody or something, and then went back and revised it back to triple A. That's the way I understand it. That should really be no surprise if that happens again. We know that this economic collapse is happening in slow motion. They could try to tell you that the housing market is bottomed and that prices are going to zoom back upwards. But who's going to buy all these homes with the amount of debt, with the mortgage rates right now? First time home buyers are locked out of the market. In fact, there's a report that just came out here that home builders are going to be downsizing the square footage for most of the newly built homes because unaffordability. So we have to make homes smaller now. I mean, if this continues down the road, we're going to have, tiny homes as the norm, and maybe people can buy, a fraction of 1 acre, maybe a 20 by 20 lot and put a tiny home on it. It'd be interesting to see what the property taxes would be on such a small lot and a small home. But if this continues, this affordability problem, maybe tiny homes will be the norm, and you'll go visit your friend down the road, and he's living in basically a Home Depot shed, type of setup. I mean, I'm joking, but I'm not joking, because if things continue, that's the direction we're headed as far as people being able to afford a starter home. Hopefully not, though. Hopefully we'll see a correction. Hopefully the powers that be will allow some deflation and will allow the cost of living to come down. But historically, when the cost of living starts coming down, they do emergency rate cuts because it's an emergency. Prices are falling, and the wealth effect is fading away because people are losing home equity. Oh no, we have to help these people that are losing their home equity. In the meantime, they're paying property taxes, and even homeowners are barely living paycheck to paycheck. But yet we have to help people when home prices fall because they're losing their equity. Oh no. Apparently I have about my home equity is close to $400,000 because I bought this place back in 2010. So if I sell, that'll be nice. But guess what? I'm not going to sell, because if I do sell, the grass isn't greener on the other side. I have to go pay rent somewhere. A similar size home, and here in San Diego, I'd be paying probably $3,000 to $3,500 a month in rent, which is actually more than my mortgage. If I could find some place that I really loved, I'm from San Diego, so it's hard for me to find a place that I love as much as San Diego. But if I could find a place, if I didn't have, young ones in school right now, and if I can go buy a place, that much cheaper, then I might make the move. But right now, it's not worth it to do that. But anyways, it's just equity. It's not real wealth. Sure, it looks nice on paper, but I'd rather have I'd rather have much lower equity and pay lower taxes, if I had to make the choice, because I'm not selling. And I think that's how a lot of homeowners look at it. But you have the home flippers out there. You have the people in the business of real estate to make a profit. Of course, they love rising prices, and they love endless housing bubbles. Speaking of housing bubbles, we're going to see more pressure on home prices. Why? Because mortgage rates shot back up today based on the 10-year Treasury. And we're approaching now a 1-year high on this 10-year Treasury. We closed out today at 4.19 on the 10-year Treasury. So mortgage rates shooting back up 7% and beyond, depending on exactly what you're looking at. For a 30-year mortgage, though, it's going to be some pain out there for a lot of home buyers. And someone that gets desperate to have to sell their home, the pool of buyers is going to dwindle even more. And as time goes on, just naturally, the pool of buyers is going to dwindle. The thing is, we have still a lot of investors out there buying homes. And here in California, for example, about half of all homes are owned by investors. When you look at the home ownership rate nationwide, it's closer to about 67% the last time I checked. In California, things are so unaffordable. It's about 50% here in California. The home ownership rate is only 50%, meaning half the people are renting, which is, a lot lower than the rest of the nation, where you have about 67% of people on average owning versus about 33% of people renting. So very unaffordable. And when the bubble bursts, it's going to be California first. That's historically how it's been. Will they allow the bubble to burst? I mean, I hope so. I hope they keep rates high. Some people say, no, that's a bad idea. The economy is going to crash. Well, we need price corrections to happen. We need to have price discovery. This would lower the cost of living. When bubbles burst, it's devastating to people that bought at the top, yes. But overall, it's good because it helps people with a lower cost of living. And guess what happens to rents? When home prices go down, rents are also forced down because more people getting into a home to buy, to own. It's going to be less people trying to rent or having to rent. So one market corrects the other, so to speak, right? So if rents crash, that's going to have an impact on home prices. Home prices crash, have an impact on rents, vice versa. It goes both ways. Let's get into some other news here, though. Now, when it comes to this economic collapse, a lot of people are complacent. A lot of people believe that as long as we can print more money, that some really bad things will never happen here in the U.S. Well, here's what's likely to happen, and it's right around the corner, in my opinion. The U.S. dollar is going to be so shunned globally that we're really going to see inflation take off. We haven't seen markets correct like they really should have, considering the rising rates. And a big part of that is the weakening U.S. dollar. Now, when you compare the dollar to other currencies, right now it's the less stinky shirt or less dirty shirt in the dirty clothes. But what's going to happen when gold is announced out of the BRICS nations coming up here? And even if it's not tied to a weight of gold means you can get a certain amount of gold for one bit of currency, right? So let's say one of the bills, let's say a brick bill, a brick dollar bill. Let's say a brick bill is worth an ounce of gold, right? So you'll have $2,000 for each one of these bills. I mean, I'm not saying that's what's going to happen, but just theoretically, that means it's tied to a weight of gold, right? So that's the way it used to be in the U.S. before the 1970s, is the dollar was tied to a weight of gold. So what's going to happen? Nobody knows. Well, we can speculate, but we're going to see in August. But just the newly found confidence in that currency would be devastating to the dollar. If many people start dumping the dollar, you're going to see rates rise even more. But that would actually be deflationary. So you have the dollar losing its value, which is inflationary, combined with deflation if rates rise because of that, right? So they could always come in and push rates back down by just intervention, just lowering the funds rate, etc. So a lot of things could be manipulated and done. So it's impossible to say exactly how it's going to play out. But what I try to encourage everyone here to do is try to play both sides, get ready for inflation, get ready for deflation. And that way you're going to make gains in this market no matter what. Keep stacking. My favorite thing is still silver. And when silver is unleashed from the manipulation, it's my opinion that we're talking hundreds of dollars per ounce. Right now we're under 25 still. And look, in the 1980s, it was $50. So just inflation alone should already have silver close to $100. So we know that they're manipulating it. We know that they're shorting the price on the paper markets with futures contracts. And we know that central banks have unlimited shorting power to go in there, and they can even fund trading houses to short the price of silver down. The Fed window is open. And, that's what happens when you have that sort of money that can just be created like that. You can really manipulate prices with the click of a mouse. Nobody knows what silver is really worth. With all the industrial uses, some people say $500 an ounce. We will, in the very near future, see we will in the very near future see true price discovery in the markets, in precious metals, and those of us that are investing wisely are going to be paid handsomely. Thanks everybody for supporting this channel. I really appreciate it. Got a couple quick shout outs to get to here, and we're going to wrap this one up today. Thank you to the following friends for your support through the super thanks button down there below this video. DJ Jojo up in Michigan, thank you very much. Ann Arbor, Michigan. DJ Jojo, thank you. We've got Deirdre85, or rather DRYDE. Sorry, I slaughtered the pronunciation there. Penjman G. We've got some screen names here I'm trying to figure out here. Penjman G. $34.95. Thank you for the super thanks. I've seen you also down there before. You kind folks, are keeping the channel alive with your super thanks, even with your thumbs up. You make a comment that helps the channel. Thank you everybody for your support. Big love. Keep stacking. Bye for now, everybody. Peace.